Today, we're going to talk about trade management protocols. Now, in recent weeks, we've been talking about the importance of exits, that exits are far more important than entries. That every great trader I know is great at exits. So today, we're going to talk a little bit about the mindset of trade management and trade management protocols. So one thing that's important to remember is there are many ways to manage a trade, but you want to manage your trades in a manner that reflects your personal psychology. The way you manage your trades will have a significant impact on your profitability. Many traders utilize what we call negative reversion strategies for both entries and for exits. And this is typically suboptimal and has a negative impact on profitability. So the big thing we want to remember is that your psychology plus your system equals your equity curve. Your psychology plus your system equals your equity curve. Your psychology is either going to improve your system or it's going to harm your system. If it's good, it's going to be additive and your equity curve will be higher. If it's poor or weak, it's going to be a subtraction or a negative that takes away from your system. One of the best books that I've read in recent years, I highly recommend. I was like, when I read this book, it was so much like how I think about things. The book is called Alpha Brain, How a Group of Iconoclasts Are Using Cognitive Science to Advance the Business of Alpha Generation by Stephen Denier. Now, Stephen Denier in his own right is one of the most fascinating people I've ever seen. He's set several different world records in completely different disciplines. And he talks about how to maximize your time and your potential. But anyways, in this specific book, he was talking about cognitive science and how to think about managing trades. So here he's setting up a trade, looks probably somewhat similar to a trade you might do. It has a trading range, and he's basically looking to buy at the bottom of the range and for the market to oscillate to the top of the range. And that's what he's looking for to make on the trade. So this is the upper end of expectations. This is the lower end of expectations. This is the underlying. So notice what he did here. He puts his stop outside the lower end of expectations. That way, something will have shifted if he gets stopped out. And notice on the top side, he's putting a take profit just inside the upper band of expectation. So if it trades up to his target, he's already out. So this is a great way to think about managing your trades. We don't want to get out unless we know we're wrong. People get out for all these other reasons. They're scared, they're nervous, they don't want to give the money back, they have the need to be right bias, all these sort of things. And they get stopped out of trades that they frankly just ruin them. If they just stayed back, kept their stop or their exit below the lower bound of expectations, they never get taken out. So what do most traders do instead of unwinding the position? They move their stop loss up, thereby effectively rebalancing the risk reward. While it may appear to be rational, it is not. If you follow me, this is one of the things I pound on all the time. Moving up your trailing stop is usually a big problem. Everybody's like, oh, I moved up my stop. My trade is safe. Bullshit. You're pretty much guaranteeing you're going to get stopped out. So think about what he's saying here. It's really fascinating. The reason is that the upper and lower expectation bands represent discrete moments. What that means is the probability of the market trading just above the upper band is disproportionately lower than the probability of trading just below it. In other words, it's going to trade below the upper bound, not above the upper bound. So if you want to set a high probability take profit, set your exit or your take profit inside the upper band. If that makes sense. So we see this here when we take this graph and we turn it on its side. Here's the upper bound. We take our take profit inside. Here's the lower bound. We have it just outside. On the other hand, the probability of spot trading just below the lower end of your expectations is also disproportionately lower than the probability of it trading just above the lower end. Therefore, you don't want to be stopped out while your view is still in effect. So if you think you're right, you want to get out when you're wrong, not until then. So you should set your stop loss just below the lower end of your expectations. If you were to raise your stop loss with the objective of rebalancing the reward to risk, you're shifting the probability of triggering that stop loss from very low of getting triggered to very high. So while you are reducing the magnitude of your potential downside, you're almost guaranteeing you're going to get stopped out. So here's our distribution, and we had our exit over here. Well, now we moved it, and now look where it sits. It sits right in the middle of the distribution. This is why it's so likely it's going to get hit. So when people move up their stop, they move it up into an area that's pretty much guaranteed it's going to get hit. It doesn't help. It makes it worse. So what Stephen is saying is that the rational decision would have you reduce your position when momentum traders are loading up and loading up when they're stopping out. If you are an investor who expresses a view based on fundamentals, momentum trading is completely incompatible with your approach. In fact, it's downright corrosive. Do it often enough and you'll find yourself saying, well, I got my view right, but I didn't make any money. How many of you have nailed your view of a market and lost money doing it? I've done that. I know what it's like. So another element I want to share with you is that stops hurt. You hear me talk about this a lot, but this is from Larry Connors from the book Short-Term Trading Strategies That Work. So Larry said, for many years, I advocated the use of stops in my trading. And if you look at any of my published work up until 2004, you'll see the words use stops along most strategies. In early 2005, we started running tests with the hope of identifying the optimal stop level to use. And what came back was completely opposite of anything we ever imagined. We've run literally hundreds of variations of stop tests, and they all come to the same conclusion. When it comes to stocks and equities, stops hurt. So what you see here is with no stop, the trading strategy, which is basically a stock is above its 200-day moving average, and we go long at a 10-day low. And we get out when it reverts to the mean. So you can see 236,000 trades, 70% winners, average profit of 0.58%. Now notice if he starts instituting stops at 1, 3, 5, 7, 10, and 20%, immediately the average profit loss gets crushed. Percentage of winners gets crushed. And the trades go up because you're getting stopped out or going back in, getting stopped out and going back in. Or if you don't have a stop, you're just in till the trade's over. So you can see that basically using a stop, you have to have a gigantic stop before it's even close to having no stop. So no matter where the stop was placed, it hurts performance. The tighter the stop, the worse the performance. Okay. So with stocks reverting as they do, you can see from hundreds of thousands of setups that the stock will drop, the stop gets hit, and then the stock reverses and proceeds to rally, but without you on it. Now, I have some very specific views on this that we're kind of beyond today. I do use initial stops in some cases. This is why I love options, because I can build trades. I don't need an initial stop if I so choose. But I have very specific ways that I manage this, and I absolutely avoid ongoing stops. They are a big problem. So here's just an example. We have our upcoming Matrix Money Machine workshop starting on June 10th. And you can go to vanthorpe.com or tradingmatrix.com to sign up for this workshop. We teach a system called the Simplified BB Gun. We have a bunch of different samples, but here's one of them. I want you to notice that the Simplified BB Gun with the stop is 232 trades, 85% expectancy, 50% win rate, average win to average loss to 2.7. This is an excellent system. But look what happens if you get rid of the stop. The expectancy goes from 85 cents to $1.06. The win rate goes from 50% to 66%. And the average win-loss actually goes down to 1.5. This is a better system. So you can see the stop hurts. So I encourage you to think about this issue and how are you choosing to handle it? Do you have a stop? Do you tighten your stops and have trailing stops? Do you understand how you can use options to replace the stop? We had a trade in Occidental Petroleum, OXY, that we bought calls. Trade didn't work. We would have got stopped out in underlying, but because we were long calls, we didn't get out. And then all of a sudden, late last week, the market turned and took off. And today, Oxy was gapped up higher. Now, it faded a little bit at the end of the day, but the point is, we're still long with a trade that's not working. That if we had just had our stop, we'd have been out a week ago. So this is one of the advantages that it does. So are you prepared to use options? Do you use options and option structures to limit your risk and frame your trades to have big winning Rs? This trade management protocol is huge, and this is one of the big places where you get to act elite. You get to act like a pro. So check it out. Remember, we do a Trader Tip Tuesday every Tuesday. Tune in next Tuesday, where I will teach you different ways to think about trading that will help you up your performance to an elite level. I'll see you next Tuesday, and look up the Matrix Money Machine at vantharp.com or tradingmatrix.com. Have a great week. God bless. Bye.